Aberdeen Asset Management has reopened its commercial property fund for trading. It is the only one out of 7 managers in the sector which shuttered their gates 2 weeks ago following a wave of redemption requests post the EU referendum. Gemma joins us now on set to discuss. So 6 still gated, are they, as well? And presumably the one that's opened up for business, Gemma, which is Aberdeen, they have marked down significantly the level at which investors can get out. How much?
Right, so it's down 26% overall, and
26%.
yeah.
So if I had my money in there the day before, just over a few years, it was £100 I had in this, and now I get £74 back. Yeah. Right.
Yeah. So what Aberdeen's done is a completely different approach. You're effectively paying a tremendous liquidity premium. They price that at around 17%. And then you have the sales cost of around 1%, and the remainder is the long-term fair value discount they're going to apply for those who are remaining in the fund. So to get your liquidity up front, it's 17% you're paying.
17% plus 1% charges. Sorry, what was the other 6% again? Or
that's
8%?
For those who are remaining in the fund.
Yeah.
So that's the actual long-term fair value markdown they're applying for the time being.
Okay, so if those who want to panic out, it's 26% in total. Those who want to stay in, they've only lost 8% on it. That sounds quite measured, actually, about 8% off. Is that probably right, is it?
Actually, Aberdeen's been a bit more aggressive in marking down than the others have so far. We're looking at more around 4 or 5% in terms of the markdowns taken so far. And actually, Legal & General initially marked down 15%. They've brought that back in recently to 10%.
Well, what does that 8% actually represent? Because that says to me that's a figure they've almost plucked out. So actually, the real trading price is 26% lower. But actually, what we're saying is we think we've only cut our NAV or whatever the equivalent is by 8%.
Yeah, I completely agree. It's very difficult to know now. There is so much dependent on stuff we can't possibly know what's going to happen yet. How many firms are going to leave the city? How many offices are going to be vacated? These type of questions we have no idea about until we understand better what happens with passporting rules, etc. So all they can do at this point is make very loose estimates.
What about actual activity?
It's a bit of a deterrent, isn't it? If you are going to aggressively mark down the valuation at this point, what does the investor do? Well, stay around and hope for a slight rebound.
At least there's a clearing price, and this is something which I think is great. If you want to get out, here's the price.
Right, but a discounted price almost incentivises the investor to stay invested in the hope of a bit of a recovery, because you're taking a hit. I mean, look at the recovery we've seen in some of the home building stocks. Very sharp fall that you saw on day one and a slight pickup from those levels. And that is the course of action for commercial property. There could be some light at the end of the tunnel for investors worth sticking around for.
Well, it seems like it'll be a very long trajectory before we have any clear direction on what's happening. This is a market which has it takes a very long time for anything to happen. It takes a very long time for contracts to be signed, for companies to be able to get out of them. If there's new supply coming online, it takes about 2 years until it's up and running often. So this is not something where short-term outcomes are very, very obvious.
I saw a report that some of the private equity firms had shown a flicker of interest in buying some commercial property in London. Do you think they're going to come up with the checkbooks?
Well, it's imaginable that there are some sellers who are more forced than others. And so in those cases, yes, there could be some good assets. And it makes a lot of sense to sell your prime first, because that will sell. What you don't need now for these funds who are looking to raise some cash is having to sell your non-prime assets that aren't making very good money, and that will really hit sentiment again. So there could be some nice assets coming up for sale soon.
But the activity that is ongoing at the moment is being done at pretty much similar prices to people. Someone told me the other day that the real traded price hasn't come off at all.
Well, there's one deal which everyone keeps pegging this around, which was the sale of Debenhams, the department store in Oxford Street, and that achieved actually extremely expensive valuation. It came in at 2.75% yield, which actually going back the last 10 years,
the mean 4 to 6% that we've seen over the last decade.
Absolutely, and so that was seen as a very good sign, but that is really a one-off case.